Hello and welcome to the Goldman Sachs Weekend Macro Call. I'm Mark Wilson. I'm going to be joined by my colleague Adam Crook, and we'll be the hosts for this weekend's call. Given the headlines and the impact of tariff announcements through this week, you won't be surprised there'll be a strong focus on some of the tariff moves through this call. We're going to be joined first by Geoffrey Ok. Geoffrey is an executive in the Office of Government Affairs and one of our leading tariff experts. He's going to be followed by Praneet Shah, co-head of G10 FX options trading, to discuss both the implications of the tariff news on the dollar, but also to discuss views post-payroll number late in the week. We'll then have Dominic Wilson talking. Dominic is a senior advisor in our global markets research group and will pull together a number of these themes which have begun to emerge in the early days of the Trump administration. David Coon will give us an update on US earnings reports, takeaways from the mega cap tech names, as well as his views on impact of tariff news on the equity market. We're going to be joined by our new German economist, Nicholas Garant, to discuss the upcoming German election, which is now just 2 weeks away. And then we're going to finish with Kevin Daly, who is co-head of emerging market economics research. Just before we get going, can I please remind listeners that this call is for clients of Goldman Sachs only. If there is anyone else on the line now, especially members of the press, please could ask you to leave. And with that, I'll hand over to Adam.
Great. And first lot up here, Geoff Ok, executive in the Office of Government Affairs for GS in Washington. Just before we start, a caveat that we are recording this at about 5 p.m. London, 12 p.m. Eastern Standard on Friday. Just obviously a lot of headlines dynamically hitting the wires, but just a caveat for our listeners. Geoff, let's start on what we've seen over the last sort of 10 days. So after signing orders imposing new tariffs on Canada, Mexico, and China, President Trump then delayed, obviously, the Canada and Mexico tariffs until March 4th. Our economists think a further extension is likely, but the tariff risks, obviously, for both countries is probably likely to remain until at least the conclusion of the USMCA review slated for mid-26. In your view, how can we expect things to develop re Canada and Mexico in terms of negotiations and this 1 month extension of the deadline in your view? And what embodies a successful negotiation in this context?
Well, thanks for having me back here. And yes, I think it's good to be aware that things are moving quite fast, and so things can change quite rapidly. But at the moment, right, what we're expecting, right, is there's a 1 month pause that's in place. It's important, I think, to step back and look at what kind of a tariff we're actually dealing with or talking about, because they're not all the same in the eyes of President Trump. In this case, the tariffs have a explicit stated purpose of border security. So that's for both people and for alleged illicit drug traffic across the northern and southern border. And the delay until March 4th was granted explicitly on that basis, right? So that's why this tariff is being imposed. It's for leverage on getting Canada and Mexico to do things to harden and improve border control and security. And so what will happen now? Well, the two sides are going to meet. Secretary of State Marco Rubio, Secretary of the Treasury Scott Bessent, and Secretary of Commerce Howard Lutnick on the U.S. side will lead those negotiations. I think it's interesting that the president named all three of them as leading it. We'll need to watch and see who plays what roles in these negotiations. If you'll recall, in the first Trump administration, Steven Mnuchin, the Treasury Secretary, played a very outsized role on trade. And so it's an open question on whether Treasury will continue to be assigned that responsibility or whether it could fall to somebody else like Howard Lutnick at the Commerce Department. In that month that they're discussing with their these provisions with their counterparts, there are more people that are going to fall into place at agencies. So there's going to be more political personnel. Industry is obviously going to be quite active in trying to engage the government here in the United States to figure out what will happen and provide their views. And the people that are arriving are going to hear that and have a chance to weigh in and shape the policy. Now, what will happen in the longer run, right, is, and you mentioned the USMCA slated for review in mid-2026, these tariffs over time, right, could shift from something about borders control to more about USMCA leverage. That's not an explicit goal, at least that we're hearing from the president at this time. but it is something that could be expected, particularly if tariffs are imposed, right? So if tariffs end up being imposed at some point, it's difficult to see how they'd be able to remove those until you get to the USMCA review point next year. If not, right, if they're not imposed, the markets are going to have to get used to or deal with the fact that these tariffs could be threatened at least until that time period.
Great, thanks, Jeff. So let's to the 10% tariffs on imports from China that took effect on February 4th. Our economists continue to expect tariffs on imports from China to rise further for a total increase of around 20 percentage points. They also continue to expect a new tariff on auto imports from the EU. So I guess the question is, what levers do China and the EU have going forward, and what can we expect next in terms of tariffs more broadly and also other executive orders?
Great question. Certainly, the auto sector is going to remain in focus. The timing is a little unclear. I think the more interesting question to think through is how much of this will be about electric vehicles, how much of this will be geared about Chinese supply chain and interests in Mexico versus Europe, and then versus just European auto in particular, right? When you talk about the auto sector, I think the other thing to kind of think about is that President Trump has signaled his interest in other sectors beyond the ones he's targeted so far. He's mentioned other commodities like copper. He's also mentioned entire sectors like pharmaceuticals, right? So that's a warning shot, right, on where he could go on in terms of breadth. Now, broadly on tariff policy, you'll recall that one of on his first day in office, among the several executive orders that he signed was one, a very broad one about trade, and in a lot of that has induced, right, a work stream that is now underway at several agencies where they're supposed to provide a report back to the president on what is driving the current account imbalances that are persistent for the United States, and then what those agencies can do to correct for those, right? So how to counteract them. So that work is underway, and that kind of spans all aspects of trade and tariff, all aspects of what could be accruing in terms of trade deficit. And that, to me, means that this leans somewhat in the direction of preparatory work for providing the case for a more universal or a broader tariff program. Now, if you listen closely to the president and his advisors, and you kind of parse their words a little bit, they are quite clear that the tariffs that they pursue on a broad basis, on a universal basis, would be separate and apart from any tariffs they would be using or threatening for negotiating leverage with particular countries. And they could be separate and apart from tariffs that are done for purely strategic reasons, right? For example, national security. So that's something to keep an eye on. But again, that work stream is underway. There's a timeline specified. They have a couple of months to prepare these reports and deliver their recommendations back to the president. Now, it's late breaking today, and remember, we're recording this on a Friday, right? Is being reported that President Trump is now preparing to levy what he's calling reciprocal tariffs, right? And so this is something that we'll have to get a little more clarity on if it were to transpire, but in terms of breadth. But basically, this has been an idea that some Republicans in Congress have floated for some time, which is that the president should use his authority to apply tariffs on imports from countries that are equal to the tariffs that the trading partners impose on the U.S.'s exports to those countries. In other words, they would match the exact tariff level that the U.S. faces with another country, and they'd apply that tariff, and they'd mirror that tariff back to the country for their exports coming to the United States. So again, that's the latest announcement. It's unclear kind of where you'd when the timing of that would be, if that would be immediate or if that would be delayed. And certainly this would mean a variation in country by country. So in my view, if they do pursue this, and this reporting is accurate, the reciprocal tariffs are kind of somewhere in the middle, right, of a universal tariff and one for negotiating leverage, because it will be quite broad in terms of its application, but it will still be different country by country.
Thanks. And our next speaker, Praneet Shah, who is global co-head of G10 FX options trading. Praneet, thanks for joining. You know, it's been quite a back and forwards in FX over the last sort of couple of weeks. How are you thinking about tariff risks now?
Thanks, Ricky. It's been a bit of a roller coaster, really, the last couple of weeks. It really feels right now the market has taken down its probability that significant tariffs at least are coming, at least towards Mexico and Canada, and to some extent China. I think if you look at price action and the nature of our flows, you'll actually see that the height of the panic and the height of expectations around tariffs really were the previous weekend when Trump had announced the tariff on both Mexico and Canada. We saw wholesale buying of options to protect against this scenario. And subsequently, following the delay, you've seen the price action not only in options, but in spot. And you've seen this also in euro dollar. So the market has taken the dollar weaker against all these crosses. And euro dollar in particular, it really feels as though the market's throwing in the towel on this tariff trade. I think what's quite interesting, however, is at the same time, if you look at our research, the guys have actually increased their baseline scenarios and probabilities that tariffs are eventually here to come. So starting with just Europe, they've got a 70% chance that you get a 25% tariff on autos and a 40% chance that eventually you may get a universal tariff on all EU imports. Now, these are pretty significant probabilities and outcomes for euro, and just purely on the basis that it sounds like he's been a bit softer than people expected on Canada, Mexico, and China. Understandably, the market's taken down probabilities of a harsher outcome on Europe, but it really feels as though markets may be missing something here, especially if you read what our research guys are putting out. It does sound as though the risk premium, and we're of the view here on the desk as well, trading in G10, the tariff risk in euro may well be underpriced. And a simple model that we've tried to use various models, PCA, rate differentials, but we ultimately get to euro dollar at the moment exhibiting about a big figure of tariff risk premium in the currency. And this has varied quite significantly from time to time whenever you've had a terms of trade shock, but typically you'd expect around a 3% risk premium in the currency. We saw that on around Russia, Ukraine. You saw that at the height of the panic when the market was worried about tariffs. And we only have a big figure right now. So it really does seem as though the market's underappreciating the fact that tariffs will eventually come. But understandably, look, it's been a really choppy trade to hold. Right now, I really feel the risk premium in these currencies is mainly reflective of positioning and just how difficult that trade has been to hold and carry at the moment.
Great. Thanks for setting the scene. So let's kind of recap a little bit. You know, what client activity has the desk seen around this theme? How positioned do you think the long dollar trade is? And, you know, what's your favorite trade at the moment around this theme?
Yeah, I just alluded to positioning on the dollar and how difficult it's been to hold this trade. And if we were to put some numbers around it, if going into previous weekend, I'd say positioning was actually really light. I'd say on a scale of 0 to 100, positioning only was at about 20% of long dollars because you already had round one of capitulation around the inauguration event. So I think the franchise flows are really light. People weren't willing to hold risk premium. You saw this in our option flows, whereby in December, we'd seen record buying of Vega from our franchise, only for it to all be sold out in January. And you've really seen a very similar price action this time around as well. We saw a real ramp up in long dollar positioning after the weekend. I'd say Monday open, we were getting paid for around $10 a Vega on the G10 side. And only within a 24-hour period later, we got given back the $10 a Vega as clients just were really quick this time to throw the towel in the moment tariffs were delayed on both Canada and Mexico. So this really is round two of capitulation. If round one was the inauguration period, round two has been the previous weekend. And you can now really see this in our flows. So risk premium across the board has repriced lower. Looking at our positioning metrics, the option component, which typically has been what the hedge funds have been using to position for the long dollar trade, That's almost close to zero now on the long dollar side. The aggregate long dollar position, which has pretty much been dominated by the CTA community in our reports, that's now sitting towards the lows of the year. And purely from when I look at our Vega flows now, we're actually got a net selling of vol for this week. We're going to end on, and our hedge fund franchise is typically skewed to buyers of vol. There's very few weeks when I look back at our data set that we typically get given vol, and we're actually going to end up this week with a net supply of vol. So it speaks to a market that's really at the moment struggling to hold on to the long dollar theme. It's been incredibly choppy to trade, and it's reflected in how much the vol swinging, how much we're seeing buying and then flipping of the position within a 12-hour period. So the conclusion really here is that it's a really difficult trade to hold. It's reflected in the positioning. I've just described previously, we think there's not enough risk premium in the currency relative to our research forecasts on tariff expectations, but I really fully have sympathy on how difficult it's been to hold. So positioning's light. And if you were to ask me now, what's the best way? How do I actually hold this trade now into this March, April period? I think there's one of two things to look at. So one, we really like holding the forward vol right now in euro dollar. We've been looking at buying 2-month straddles that start in the future, so on the 28th of February. We've chosen the 28th of February because you want to own volatility around the March and April period where they're going to review the Mexico and Canada tariffs. You're going to see the 1st of April review, the broader review on tariffs. That's forward vol is pricing it around a mid to high 7 handle in euro when current realized is at 9. And if you actually have a look at an average of where euro dollar 2-month vol has been since pre-election, it's around 7.7. So to me, it seems like a really asymmetric way to hold the position. And look, let's face it, it's only been a few weeks since Trump was inaugurated, but it's an incredibly volatile period. The fact that we have people, especially on my desk, having to work at 2 a.m. at night purely because of the odd headline here and there speaks to a market where it's really difficult to hold a short gamma position. So inherently, I do think we'll start to see a risk premium, almost a liquidity risk premium, start to be embedded in FX options. And that's why I really think long vol and long gamma is the only way to navigate this market and give you holding power for these positions. So we like it in forward vol format at the moment. You may well have a tariff news vacuum in the next couple of weeks. I think the market will again start focusing on this theme in March and April. And look, the forward vol gives you holding power because you're not really decaying away up until waiting for this tariff outcome. The second thing we like in the vol complex for euro is, I mentioned before, vol is spiking higher. The last time we saw vol to this degree was back in 2022 when the market was trying to trade this FCI tightener. But interestingly, this time around, it's not really reflected in the implied price of vol. And when I say implied price of vol, that's the fly, the cost of convexity. The cost of convexity in euro is sitting on the local lows at the moment. And there really is a paradox here. You're pricing implied vol towards the local lows, but the realized vol is slowly climbing higher. So you really do need to be positioned in 2 ways. One, long the forward vol to give you the holding power, but 2, you really want to be owning some of these wing outcomes in the portfolio. So we've had a look at quite a few trades. You can either hold it in forward vol format, but really simply, I'm just looking at the distribution here. Time of recording, spots 104, a 3-month parity binary is around 12%. You know, you're talking about 8-to-1 odds there on an outcome we expect if you do get any realization of these tariff outcomes. So I think the vol's the right way to go, and those are the formats we like to express it in.
Great, thanks, Praneek. So, final question to you. Outside of the tariff theme, what other themes are gathering attention in FX?
Yen, surprisingly, has been quite in focus this week, and it really didn't have many people looking at it when all we were talking about was tariffs. But the moment the tariff agenda has come out of the news flow, we've really seen a big shift into people looking at yen. So One, I think you had a hot wage data set earlier this week. Two, you had slightly more hawkish rhetoric from the Bank of Japan. Three, there's a narrative at the moment where market participants are saying, look, the Trump administration may well deal with different nations in different ways with regards to trade. So we've just said that Europe may well be the target for the bulk of the tariff revenue generation. But when you look at a country like Japan, the way that they may deal with Japan is via unilateral currency adjustment. So when I say that, could they be a quid pro quo whereby they say no tariffs for Japan, but in return, try and generate effective real exchange appreciation? So this narrative really has caught hold of discussions I've had with clients this week. And to that note, there's no surprise that we've seen interest to get long the yen, not only short dollar yen, but all the crosses as well: euro yen, sterling yen, Swiss yen. And it speaks to that theme whereby if you're seeing tariffs in Europe, but you're then effectively managing Japan via the exchange rate, it becomes a much cleaner expression of the tariff trade more broadly. So that's been the big theme. And I say the second theme is people really unwinding short yen carry trades and instead choosing to fund via Swiss. So when you look at the vol to carry ratios, short Swiss is the better Sharpe ratio trade than short yen at the moment if you're looking for funder. But two, you've also got the Munich Security Conference, which has also generated some discussion with clients. And if you do have a scenario where there is any sort of right tail here where there's a Ukrainian peace deal, Swiss again would be the FX pair, which would expect to suffer the most under that risk on outcome. So Swiss yen, there's no surprise you've seen interest in that cross as well, but you've also seen a more broad theme of people funding in Swiss rather than yen.
Great. And for our next section now, we'll bring in Dom Wilson, Senior Advisor in the Global Markets Research Group. Dom, thanks as always, for joining and helping us, sort of shine a light a little bit on market moves and market expectations. So the last 10 days, Dom, tariff-related moves have been playing out really with, pretty violent velocity across the markets, backwards and forwards as the headlines hit and then kind of retracted. I guess sort of taking a step back, Europe, as we've heard, could be next in line for tariffs. In China, the markets are weighing the full extent of possible announcements and ensuing dollar CNH moves, PBOC reaction functions. Across the board, I guess there is little conviction on how to trade this theme, given how dynamic it is. How do you suggest investors play this on a short and long-term view, in light of this being, potential trade war 2.0?
Yeah, thanks, Adam. I mean, obviously, and Jeff was talking about it just now. Large number of shifts, lots of headlines. The fact that you had to give a warning about when we're making the recording is an indication of how short the time horizon has become in terms of learning new information. And look, I think what I would say at a high level is that kind of volatility is just inherently tricky to manage. I think we're learning a few things in terms of what we've seen just over these early weeks. I think the first is obviously that, the environment's highly unpredictable, but you have to sort of remember that a wide range of options are still on the table. I think it's important not to overweight the information that one set of actions has for the next. We had relief around no tariffs appearing kind of on Inauguration Day or right after that. That relief did not carry through, strongly to an implication for the following week, where we had more aggressive tariffs proposed against Canada and Mexico. That then didn't necessarily protect us against the notion that those would be quickly removed. We're seeing again a re-upping of kind of tariff threats coming into the end of the week. And so I think the base case that we have is that tariff tail is certainly going to hang over us for some time, that there will be more action. I would say I have some skepticism that the path itself is knowable, in the sense that we have real edge in guessing what's going to happen, and I think you do have to prepare more for different outcomes and think more about the distribution than trying simply to guess what happens next. I would say the second thing for me is that the market's revealed a bit more about how it thinks about that tariff tail. When we had the more significant bouts of tariff action, what we're seeing more recently is clearly equity negative, not just for non-US, but for US equities. We've seen a tendency now a bit more for the curve to flatten, for yields to go down at least sort of further out along the curve beyond the more immediate delays that the Fed might experience. And the dollar is obviously moving, stronger on those shifts. We've seen also, today that you've had a negative impact on consumer sentiment, inflation up, growth down. So, some signs that consumers are also seeing that dynamic kind of play through. The third thing I would say is that we also know some tariff risk is clearly priced. So the absence of tariffs produces relief. I would say we're seeing a little bit that there's probably more risk priced in the obvious targets, China and perhaps to a degree Mexico, where tariffs have been broadly expected, than in other places. Chinese equities were up after the announcement of China tariffs, even before it was clear that we were not escalating further. And so I think surprise targets, places where people have been less focused, have more leverage. You mentioned, I think rightly, that Europe is, the focus has not yet shifted there, but we think is probably coming. So, that is something to kind of keep in mind. There's more risk to the places that have not been drawn in, or where the expectations are not as confident. The fourth thing I would say is just assessing the duration of tariffs makes it harder. Jeff drew the distinction between these sort of tariffs as leverage or, tariffs as strategic choice. So far, we've mostly been dealing with the kind of notion of tariffs as a threat for other actions. I think we will evolve over time to having, more tariff proposals that reflect a strategic choice that are more likely to be persistent, and then the effects, of those probably also a little bit more persistent. When going to sort of what to do with this, I think, that what makes it challenging is there's this sort of potential relief as well as downside. And I think, as I said, focusing on the distributions is where we've sort of tried to, put our energy. On that front, I think the market struggles to make the tail fat enough for the bad outcomes. So on that basis, long dollar optionality, that kind of upside tail in the dollar, I still think is underpriced. It's just hard for the market to price it significantly enough for what's even a kind of modest risk of some of these much more significant trade outcomes, which I think are still on the table. I would say mostly against the majors, probably still put the euro at the top of that list. Maybe things like the Sing dollar that get some of your North Asian risk too. I think at least some of that exposure should be held over a medium-term horizon. I think, there's been a tendency to focus too much on the short-dated timing. The challenge is that leaves you with less exposure to kind of faster, earlier moves if you structure things that way. That's harder. I think so far, the pattern has been that you need to be in a position to add when the market relaxes about these risks, and reduce when the market kind of prices real risks, at least for that short-dated exposure, and monetize things quickly and be in a position to reload. But it's easy to say that, and that is a real challenge in terms of trading it. As vol comes in, I would say the downside, downside tail in equities has been worth protecting. Each time we've seen that volatility come in, we're seeing kind of risks rise again on the other side of it. So that's the first set of issues. The second, I think the market's been underpricing the upside tail in the non-US economies that could come from relief. We've talked about upside in China-related assets over the last kind of few weeks coming into the year. You've seen some of that play out already, and in Europe too, that's already happened to Greece, so a bit less appealing now, but I think that upside tail is also underpriced, so you have sort of tails mispriced on both sides. And third, I would say, we think tariff risks, obviously make it possible that the case for the Fed to start later is going to get stronger. But ultimately, I would say, looking further out, we think that mostly argue for lower rates. So I would say that creates some risk to steepening trades, and as looking at 2026 Fed pricing, where there's basically very little cuts priced, I think, over time that there should be more easing priced there. So that's another area that we've been focused on.
Thanks, Tom. Very useful. So let's take a step back. A question we're getting from clients quite a bit now is, US exceptionalism as a theme has, been, very dominant really for quite a few years. How vulnerable is that to challenge, and what are the market implications if the market loses faith in US exceptionalism?
Yeah, it's a good question. Obviously, kind of become a much stronger focus, particularly as people feel like they're exposed and positioned to that theme. At a high level, fundamentals for the US economy look strong still. Our forecast has better growth in the US than elsewhere. And so the issue is less that the US economy itself gets challenged in a meaningful way, or that its relative strength gets challenged. There are obviously ways that could happen, but I think the bigger issue is really around pricing. We've already seen a large upgrade to US growth views since the September lows. Vicky and my team extracts growth shocks from US bond and equity performance. You see it there. You can see it in the strength in US cyclical stocks over the last kind of 3 or 4 months. And so, we've generally thought that shift was appropriate because we've had a robust US growth view, but I would say we're now at a point where it makes us increasingly vulnerable, to any disappointment. And on the opposite side, the market's obviously had pretty downbeat views of non-US growth, particularly China and Europe. So it doesn't take that much on the policy or data side to beat that. How asset markets react to that challenge to US exceptionalism or those challenges depends on whether you get more disappointment about US growth or more relief about non-US growth. If you think about the asset market impacts of those two things, they're slightly different. For the first, with a US growth disappointment, you'd expect to see equities, yields, and the dollar fall together. It's generally rates that are most reliably linked to a US growth disappointment, as long as inflation isn't also kind of surprising on the upside. And I would say the most likely challenge on the non-US side is probably if tariff threats end up lighter than feared, or the domestic policy response to offset those risks is kind of more vigorous or more effective than people have assumed. If you get that, you'd expect dollar weakness, but also some upside in non-US equities and possibly commodities that have priced some of that risk, and maybe with a bit less confidence, perhaps some underperformance of non-US rates. As I said before, we've argued that kind of China-related assets outside the FX area probably underestimate that kind of upside tail. But the challenge is, markets have moved in that direction already in the last couple of weeks. We've seen a mild version of this sort of US exceptionalism challenge already so far this year. US equities are up, but Europe and China have outperformed so far. The dollar and US yields are a little bit weaker, bit lower than coming into the year. I would say that's mostly been about tariff relief, but also somewhat better non-US data. And so, like I said, our baseline forecasts are not ones in which you'd expect a deep challenge to the kind of story of US exceptionalism, but I do worry a little bit that you're vulnerable to challenges to the pricing of it. And so, echoing the points I made on tariffs, we've argued that some exposure to both kind of tails, having some exposure to things that will perform if there's disappointments on the US growth side, where there's a lot of optimism baked already, and some exposure to things that benefit from relief about non-US growth. I think those kind of tails make sense for many portfolios, particularly if you're already heavily positioned around this kind of US growth and exceptionalism theme.
Great, Adam, Dom, thank you very much indeed. Our next speaker is David Costin, our Chief US Equity Strategist. David, there's obviously been a lot going on in macro world, but investor attention has also squarely been on earnings, where results have been pretty good. I think I'm right in saying over 50% of the S&P have beaten earnings by greater than a standard deviation, and that's a pretty good run rate, and 45% are showing better top line as well. It's obviously been another big week with some big names having just reported. Can you just run us through key themes that you're seeing play out through earnings season, what you think will be the theme as we get through the remainder of earnings season, and your key takeaways?
Sure, Mark. First, to give you some of the numbers you referenced, to be specific, we're about 75% of the way through the fourth quarter earnings season in terms of market cap, because some of the largest tech companies, as you know, reported this past week. So we'd be about 60% in numbers. We've had about just over 300 companies have reported their results. We've had a pretty good results, but the positive surprises that we've seen for the last 12 quarters, that's the last 3 years, have averaged about 400 basis points above expectations. And this quarter is coming in about 200 basis points, much less. And the expectations coming in was plus 8%, and they're coming in around plus 10. Now, that is, again, a smaller magnitude of surprises than we've seen. And one of the reasons for that was the very strong dollar. We had heard that from our conversations with managements really in the last part of December in this conversation. So that's not a total surprise. We were expecting a somewhat smaller magnitude of surprises. That's been one, I think, important takeaway. The second is the positive surprises on the sales side for the biggest Magnificent Seven have thus far been pretty much in line with expectations. And that has definitely been a much lower magnitude than we've seen in the past couple of years when the Mag 7 companies really had very significant positive surprises on the revenue line. So that has been the sort of the next takeaway we think is pretty important when we think about the expectations going forward. Our model and expectations are that the gap in earnings growth between the Magnificent Seven and the other 493 stocks, we expect to be narrowing very sharply compared with last year. In 2024, and obviously we're just getting the fourth quarter results, that magnitude, that gap is around 30 percentage points faster growth for the Big Seven. That's going to narrow to around 7 percentage points gap this year and maybe 3 percentage points when you look into 2026. So that's another takeaway. And the other item, the final item I would highlight is just the enormous capital spending budgets that the Big Seven companies are committing themselves to spend on the AI revolution in the coming year. Amazon over $100 billion. You had Google $75 billion, Meta $60 to $65 billion. And these are enormous capex budgets, and that's a big topic of discussions with managements because after the DeepSeek announcements last week, questions: what's the return on capital going to be? So, Mark, those are some of the key takeaways and discussion points on the results and conversations with fund managers this week.
Great, thanks, David. And then obviously the big issue of the week has been tariffs. I think you've quantified some of the downside risk to S&P earnings and to return expectations should some of the more draconian scenarios play out. There's obviously many different ways in which companies can respond to tariffs, and that's obviously going to have a major impact on earnings and margins. Just as you work through some of these issues and as you discuss these issues with investors, what's your view on likely tariff implementation impact to S&P earnings and other particular trades or sectors or stocks that you're very focused on as a consequence?
So you're correct in that the tariff has been a big subject of conversation. Mostly it's been around the mercurial nature of President Trump and the idea of tariffs on and then tariffs off and partially off and then on China, but not on Canada and Mexico. At least they're delayed and perhaps coming soon in the European Union. So a lot of uncertainty around that. We did quantify that in a report, and that's an important way of at least framing the issue. And if the proposal, as Trump was originally anticipating on both Canada, Mexico, and also on China, a lesser magnitude, that would have reduced our estimates by around 2 to 3% from an earnings per share point of view. And the risk premium increase, I'll come back to that in a moment, would have also suggested probably a 2 to 3% lower valuation. And so you combine the two together, less earnings and a lower multiple, a high risk premium would be indicating around 5% downside in the fair value of the S&P 500. That's sort of an important way of framing it. That's a base case scenario if you were to have these tariffs ultimately implemented. Of course, Trump did say he's going to postpone or put in abeyance the proposed tariffs on Canada and Mexico. So that's a way of quantifying potential downside if it was to be put forward, maybe a 5% lower level of the market. From a corporate perspective, the business in America is competitive. It's a competitive market. And so the historical experience in the first round of tariffs in the Trump administration, first Trump administration, was that most of those premium costs were ultimately passed through to the consumer. But it's not so clear. In some cases, companies push back, ask the suppliers to be more accommodative or try to get lower input costs at the beginning. In some cases, companies would be prepared to absorb some of that higher costs because they're operating right now at the highest level of margins in history for many cases, many companies. And obviously, the third option is to pass it through to the customers, which may ultimately end up at less volume. So from a trading perspective, we've seen a lot of focus and discussions around our basket of companies where most of their revenues, 100% of the revenues, are domestically driven. So here, the final impact of the tariff is maybe less obvious. It may have passed along in the supply chain, but ultimately the customer is a domestic-facing customer. And the concern has been about the retaliatory tariffs that have been raised as possible risks. And that would be more clear on companies where their revenues are primarily generated outside the United States. So that's been the area of focus and concern. So we have two baskets of stocks that clients have been sort of focusing on some of those individual companies. And that's kind of the way it's seen. And basically, it's a big source of greater uncertainty and risk premium perhaps going higher. And so that would, until some of these issues are resolved, would think it would be some limit on the upward cap some upside here on the S&P 500 near term.
That's great, David. Thank you very much indeed.
Thank you.
All right, we're going to move from the US to Germany. Nicholas Garnat is our new German economist. Nicholas, welcome to Goldman and thank you for joining. I guess we're 2 weeks away now from election day. The campaign is really entering a pretty decisive stage, especially after some of the recent movements and attempted policy, which was shot down. As you look at the campaign now and some of the polling data, what can you tell us in terms of the implications of recent attempted policy action, what it's done to the polls, and what you expect now 2 weeks out from the election?
Yeah, thanks, Mark, for having me. So I'd say up until mid-January, the campaign has been quite uneventful. Conservative CDU-CSU has been clear in the lead, but slowly losing ground to the far-right AfD. And basically, the focus was on economic issues. Obviously, given Germany's growth weakness, that's an important topic. And on that topic, CDU-CSU scored quite well with voters in terms of ascribed competence. Now, all of that changed about two and a half weeks ago after attacks by migrants in Magdeburg in December and Aschaffenburg in January. Voter focus shifted towards migration. And as a response, CDU-CSU also shifted the focus of their campaign towards stricter migration policy to regain basically votes from anti-immigration AfD. And what happened then is they introduced a motion and a law on restricting humanitarian migration into the Bundestag and voted on these together with the AfD, basically tacitly accepting cooperation. Now that led to quite a heated debate, both in the media and the parliament, focusing mostly on the question whether, you could say whether it's a mortal sin to vote together with the AfD. And most commentators expected a substantial shift in polls, either towards the CDU-CSU on stricter migration policy or away from them on outrage about voting together with the AfD. So what's a bit surprising is that actually not much has happened in the polls. So most notably, polls seem to have stabilized. CDU-CSU basically is the same level as 2 weeks ago at 30%. AfD is at the same level as 2 weeks ago at 20%. And current government parties, SPD and Greens, poll both at 15%. So those three parties are set to enter parliament. Now, what's most interesting, I guess, is that the left party, which polled below the 5% barrier that you need to cross to enter parliament, has gained across all polls and looks much likely to enter the Bundestag. And I think that's a crucial question. So which of the smaller parties, which is Liberal FDP, Socialist, Anti-Immigration, BSW, and the Left Party, enter the Bundestag and could lead to a blocking minority against constitutional changes such as fisc reform, which then could make it much harder for the next government to make meaningful changes. So I think that's one of the key topics that we're currently watching.
Thanks, Nicholas. And if you look at the current polling data, first of all, how much variance and room for error do you think there is there? Some of the more recent developed market polling data has not been particularly accurate. And then if you do extrapolate the current polling data, what would the formation of government look like? What are the scenarios for the coalition government? And what would the fiscal policy under each of those scenarios look like?
Yeah, so I mean, it's still 2 weeks, and I mean, it's a bit different than in past elections because it's just much denser with these snap elections. So we haven't had any TV debates so far. So all of the TV debates are happening in the next 2 weeks. First one on Sunday between Merz and current Chancellor Scholz. So that could actually change the polls quite a bit. Then, I mean, we usually have had quite a good experience with averaging across polls, so that gives quite an accurate picture. Some of the polls typically overestimate some parties, others underestimate those parties. So averaging across actually makes a lot of sense. But still, I mean, polling error and actually also fundamental error is still quite high because there could be still some fundamental shifts over the next 2 weeks. Now, the issues or the focus for us is on basically 3 issues. So first, what's the most likely coalition? There we currently see CDU-SPD, so SPD is the Social Democratic Party, at 50 to 60%, a 3-party coalition at 30 to 40%, and a black-green coalition at 10%. Now, what's interesting here is that the odds for a 3-party coalition have increased substantially over the past weeks by more than 20 percentage points since November. And such an outcome would make coalition talks much harder and would also likely give less clarity on the future policy path. The second issue we're watching is whether there'll be a constitutional blocking minority against fiscal reform. So our base case is there that AfD and the 3 smaller parties would vote against any meaningful fiscal reform, either because they're against loosening the debt brake, or because they're against more defense spending. And in recent weeks, the probability of such a blocking minority has gone up to now 40 to 50%, in particular as the Left Party and the AfD have gained. And then the third point that has come up quite often is whether the CDU-CSU will formally cooperate with right-wing AfD. We don't see a high chance of that. CDU leadership has explicitly excluded that. And also, if you look at the polling data, basically all CDU supporters expect the CDU not to cooperate with the AfD. So you can imagine what could happen to this support if, in fact, the CDU cooperates with the AfD. So that's why we currently exclude that. Now, I guess the most important question going forward is what does this all mean for fiscal policy? I mean, Germany in principle has a lot of fiscal space, but it's quite constrained by the debt brake. And there as I said, we're mostly looking at the possibility of a blocking minority. And without a blocking minority, our baseline is some limited reform of the debt brake, off-budget defense fund, bringing defense spending to 2.5% by 2028, also to somehow accommodate possible demands by Trump in order to avoid some tariffs. And that would boost GDP by 0.7% by 2028, and debt to GDP would only increase slightly by 0.6 percentage points. Now, if SPD or Greens get a stronger result, they are basically more prone to spending, so to say. We could see a slightly bigger reform, but I mean, nothing world changing. And then, as I said, in case of a blocking minority, we don't expect a material change in fiscal policy.
And just quickly, Nicholas, outside of migration and fiscal, are there any other big policy issues you expect the next government to deal with?
Yeah, so I mean, we put a piece out today focusing on economic reforms. Given Germany's growth weakness, which to a large part is structural, we would expect some economic reforms, in particular as CDU-CSU has, prior to the shift towards migration, made it the center of their reform. And then it's particularly tax policy that we're focusing on. As CDU-CSU have put a big tax reform package at the center of their agenda, lowering personal and income taxes, and basically reducing the tax burden by 1.8% of GDP. Now, SPD and Greens also have some tax proposals. They don't focus on broad tax reductions, but rather on focused tax rebates for corporates, for investment. And that would be smaller packages reducing revenues only by 0.5% or maybe 1% of GDP. Now, given the size of the packages, it's quite obvious that the CDU-CSU package would also have the biggest effect on growth, basically pushing GDP higher by 0.9% by 2029 versus 0.6 and 0.4% for the Greens and the SPD. Yeah, and I guess, I mean, the short-run multipliers are a bit higher for SPD and Greens because they are more investment-focused, but in the long run, this more broad-based package could be actually quite beneficial for German growth. So that's the first area. And the second area where there's a lot of consensus between parties is electricity prices. You see all three parties agree on lowering electricity prices. They target some a bit different groups, but in general, I'd expect something to happen there due to consensus. And the third area is labor supply. Both on labor migration, and I think it's important to note that all parties distinguish clearly between humanitarian refugee migration and labor migration. And while CDU is quite strict on humanitarian migration, they acknowledge that Germany needs to increase labor migration to stabilize its workforce. And then the second point where there's consensus on is increasing incentives for retirees to work beyond retirement age, for example, through mostly through tax incentives. And in that area, the most contentious bit could be social security reform, in particular basic social security, where the CDU wants to cut some of that, and SPD and Greens will be quite reluctant to do so. So that might be an area of conflict where some compromise has to be struck in a new government. Now, I would say, to summarize for the next government on reforms, it mostly depends on how strong the result of the CDU-CSU is. If they get a quite strong result, I guess they could push through a lot of their proposals, while if SPD and Greens get a stronger result, then we might see a less substantial tax reform, no real reform of basic social security, and yeah, I guess that's the bottom line there.
That's great. Thank you very much, Nicholas. Appreciate you joining, and we'll get you on again as we get closer to and through the election.
Thank you.
Okay, next, and our final speaker is Kevin Daly. Kevin is co-head of our emerging market economics research. Kevin, can you just give us the summary? How have emerging market economies entered this new year? What are the prospects for growth and inflation? And as well as those broad EM insights, any specific regions that you're focused on?
Hey, Mark. So, yeah, it's interesting. So we just updated our outlook for EMs. And one thing that's striking is that, yeah, performance in the start of this year has been really quite strong. So EMs grew pretty well last year, so 4% versus 1.7% in DMs. But really the momentum was picking up towards the end of the year. So our CAI's current activity indicators capturing near-term activity data rose to around 5% annualized at the start of 2025. That is above our estimate of potential growth of around 4%. So growth not only was strong in 24, but was actually picking up as we entered this year. Now, interestingly, if you look across regions, it was also pretty broad-based. So potential growth is clearly different. It's across the main, across LATAM, CEMEA, and Asia. It tends to be lower in LATAM and CEMEA than it is in Asia. But relative to their respective potential growth rates, actually growth was picking up pretty strongly. It's not the case that every country was growing robustly, but certainly at a regional level, there was pretty strong growth across all three main regions. Now, if it wasn't for the risk of tariffs this year, which is, as we'll discuss, a major shadow hanging over the outlook for EM economies, actually, I think the prospects for this year would be, even better. There are reasons why we're seeing this acceleration in growth. Why? Because, the big drag from tight monetary policy that we saw in 22, 23, and even into early 24, that drag is now easing as monetary policy across EMs begins to ease. So, were it not for tariff risk, actually I think the outlook would be pretty positive on growth. Just lastly, to finish very briefly on inflation, what's interesting as well across EMs is not only is growth performing relatively well in aggregate, but actually inflation has fallen very sharply. So the gap between DM and EM inflation has fallen to pretty much an all-time record low. So it's only around 1%, that gap in aggregate. And we expect DM inflation this year to fall further from around an average of 4.5% in 2024 to 3.4% in 2025. So both on growth and inflation, we headed into this year in pretty good shape across EMs.
Thanks, Kevin. And I guess we have to ask this, really, given all the action that's going on. But as tariff action has now begun, what do you expect this to mean for EM growth momentum, and also the broader kind of context for EM markets? Are there particular trades or markets that you're focused on as it relates to this tariff-induced volatility?
Yeah, so I mean, it is, tariffs. Tariffs are negative for growth everywhere, but they are particularly negative for EMs. Why? Because EM growth models are unusually levered towards global trade. So if any hit that we get to global trade is likely to affect EMs more than DM economies. So there is heading into this year, there has been a huge amount of focus, obviously in tariffs everywhere, but particularly for EM economies. Now, interestingly, actually so far, the surprise with tariffs was the particular threats to Canada in particular, but also to Mexico. The size of that, they've now been dropped, of course, postponed at least for a month. The tariffs have been imposed on China additional, but they're actually somewhat smaller than we were anticipating in our baseline scenario, at least for now. So for EM, so far the news has been slightly better than expected, and you're seeing EM assets perform relatively well, partly as a result of that. But I emphasize the word so far, is that obviously we're less than 3 weeks into this new US administration. There's still a lot of news on tariffs still to come. We think, given that ongoing tariff risk, we're still in a stronger dollar environment, stronger for longer dollar environment. But we do think there are some pockets of value across EM. So we quite like, we like high carry EM strategies, particularly those, funded not out of dollar, but funded out of the euro, where our strategists are relatively negative. So we like the Brazilian real against the euro in particular. And some of the best performing trades this year across EM space have been these high carry currencies, where the investment proposition is pretty much idiosyncratic to the tariff news. So we're looking at recovery stories, particularly the likes of Egypt, Nigeria, even Turkey, which have performed relatively well, in part because they provide a lot of carry, and also, as I say, the investment proposition is unrelated, largely speaking, to what the US administration does.
Thanks, Kevin. That's great. Appreciate you being on.
Thank you.
Great. Thank you very much to all of our speakers this week. Thank you for listening and for dialing in. Last Monday brought us the DeepSeek news. This Monday just gone brought us tariff news. Hopefully there won't be any such surprises this coming Monday, but we will be back next weekend with the weekend call to navigate them as they arrive. Thank you very much for listening. Have a good week in markets and good luck.
如果喜欢这段视频，请在 B 站财安君频道观看更多精彩内容。